This is the 20th installment to the series, Build Your Business into an Asset of Value. At the end of the day, the value of a business is determined when two parties, a seller and a buyer, agree to a price. In the introduction to this book, I suggested that most people start a business not out of a desire to build an asset of value, but rather out of a need to earn an income. I also made the point that most businesses end in liquidation, or the business owner simply stops trading. A very small proportion of businesses are sold. Most of these transactions can best be described as an asset sale, where the new owners pay no more for the business than the value of its assets minus liabilities. For the owner of a pro or replica business, the business is no more than an income generating machine. Consequently, these businesses never develop into an asset of value. But this book is about entrepreneurs aspiring to build a business into an asset of value, where the value of the business is not simply assets minus liabilities. In this chapter, I introduced the profitability multiplier method of business valuation because it is commonly used by investors and their representatives. But I have serious concerns about the usefulness of this method. In this chapter, I will explain why. The profitability multiplier method is predicated on the principle that the current value of an asset can be determined by discounting the future income that may be derived from the asset. I am sure by now you can guess that this method is based mostly on the information contained in the profit and loss statement, and more specifically, the earnings generated by the business. This method of business valuation consists of 3 steps. Step 1, calculate the business's earnings or profits. Step 2, decide on the multiplier. And Step 3, adjust the value by adding certain assets and deducting certain liabilities. Step 1. In Chapter 10, I explained that in accounting terms, there are 4 types of profit. For this method of valuation, we are interested in operating income or operating profit, often referred to as EBITDA, earnings before interest, tax, depreciation, and amortization. Operational income is most often accepted as a proxy for earnings. But operational income, as per the profit and loss statement, does not always reflect earnings realistically. Business owners commonly run expenses as operational expenses through the business account that may be best described as superfluous. Examples include a salary for a spouse not actually working in the business, personal expenses like cell phone accounts for family members, life insurance premiums that should really be run through the personal bank account of the director, and debt installments related to personal use assets like cars, boats, and other assets. These expenditures should be removed from the calculation as they are not business-related expenses, and their inclusion gives a distorted picture of the business's real operational expenses. But in certain cases, expenses should be added. For example, remuneration for a yet-to-be appointed business manager if prospective investors do not want to work in the business as owner-operator. There may also be extenuating circumstances that may have affected operational income over the preceding years. Examples include the business may have had to pay severance packages due to retrenchments. A large customer may have declared bankruptcy and as a result defaulted on making payments to the business. Or the business may have been awarded a large settlement related to a legal dispute. Prospective investors gain a more realistic picture of operational income by making these adjustments. As a rule, operational income should grow by at least 20% per annum for a business to be attractive to investors. Step 2. Decide on a multiplier. In first world economies like the United States of America, Western Europe, and parts of Asia, venture capitalism is well established. Thousands of private businesses are bought and sold. In some jurisdictions, venture capital is either self-regulated or regulated by the authorities. As a result, information about these transactions is publicly available. Prospective investors can access information from which multipliers may be derived, applicable to private businesses in a wide variety of industries. For example, a 2 times multiplier may be applied to businesses in the logistics industry based on the sale of businesses in the sector over the preceding years. Step 3. Adjustments. In certain cases, investors may add or subtract certain items from the calculation. Items that may be added include cash on hand, working capital, and inventory. Items that may be subtracted commonly include debt, an overdraft, trade finance facility, asset finance, and long-term debt. Following these 3 steps, the investor arrives at a value for the business. The profitability multiplier method of business valuation has, in my opinion, a limited application for the following reasons. The multiplier. As stated earlier, statistical information about the buying and selling of private businesses is widely available in first world countries where venture capitalism is well established, but not so in developing countries like South Africa. The South African Venture Capital and Private Equity Association issues an annual report which I highly recommend, but the information contained in the report is limited. Since 2010, survey participants reported on only 1,106 active deals, according to the latest publication. The report provides headline statistics only. Nothing is revealed about individual deals. It is therefore near impossible to derive useful multipliers applicable to local market segments. The profitability multiplier method of valuation ignores important factors that prospective buyers must take note of, including transferability. In Chapter 1, I introduced the account of a customer who operated a business that designed and built electronic timing devices for the manufacturing sector. The owner and operator of the business was highly skilled in a specialized field, and he earned very good money from his business. By the time I met him, he was already a very wealthy man. But when he passed away, the business ended abruptly and was liquidated for very little money. The reason for this is that the business was not transferable. There are very few electrical engineers specializing in electronic timing devices with capital and a desire to take over a business like this. Even if I had used the information contained in the financial statements of the business to apply the profitability multiplier method of valuation, it would not have mattered, since finding a prospective buyer for this type of business was near impossible. Customer concentration. Just looking at the earnings of a business, however impressive they might be, reveal nothing about the customer base of the business. Often, small businesses have a very concentrated customer base where the business is dependent on long-standing relationships with a small number of customers for most of its sales revenues. A new owner cannot assume that existing customers will continue to support the business when the original owner leaves. Supplier risk. I recently had a conversation with an executive of a very successful business that consistently generates large profits. But the business is wholly dependent on using software under license from a single supplier. The future of the business in its present form depends totally on having the licensing rights, which I later found out is subject to a 1-month notice period. This poses a major risk to the business. Market risk. Understanding the risks competitors represent requires deep insight into the specific market, trends and technologies that impact on businesses in the sector. Technological advances can contribute to the competitiveness of a business, but may also pose severe risks. Think of how the technological advancements related to using smartphones and online payment mechanisms impacted the taxi industry when Uber was launched. Legislative and regulatory risks. Recently, the South African government proposed legislation that will have far-reaching implications for the medical aid industry in South Africa. Regulations, often with good intentions, can be severely damaging to businesses. At the end of the day, the value of a business is determined when two parties, a seller and a buyer, agree to a price. But business owners who want to maximize the value of their business cannot wait passively for the day when they want to sell. Doing so will likely result in the business being sold for a fire sale value. A better way. I propose that business owners should adopt a better way. Build a business with a specific type of buyer in mind. Then, having identified your prospective buyer, decide what business characteristics will most appeal to that specific type of buyer. I propose 6 types of potential buyers: owner-operators, angel investors, venture capitalists, and then what excites me most is the last 3. Sell the business backwards, forwards, or sideways. In the following chapters, I will consider each of these types of prospective buyers. What is important to them, what business characteristics they are looking for, and what can business owners do to make their business as attractive to buyers as is possible. Thank you for watching. To access the full series, visit Constructum Online Learning on YouTube or click on the link in the post.